Treasury Secretary Scott Bessent has confirmed the names of 5 finalists to succeed Federal Reserve Chair Jerome Powell. President Trump has said he expects to make his decision by year end. Joining me to handicap the selection process and talk about the Fed's decision on interest rates this week is Stephen Juneau, America Securities senior U.S. economist. Stephen, it's great to see you. So, I mean, these names have been floating around out there already. It seemed, how much attention is the market paying at this point? And at this point, would they be happy with sort of any of these selections?
Well, I don't think the market's too focused on it right now, just because we have a Fed meeting this week. We're still trying to decide, is this labor market slowing down significantly? Is it just gradually cooling? What's the Fed going to do after the next meeting? How's it going to deal with the shutdown? So I think right now the market's really focused on the near term for Fed policy. Chair Powell's still there. But of course, this will come up more and more, especially if we do get that announcement by year end.
It seems to be sort of looming over the process less than it was at a certain point, Stephen. Okay, so let's get to this week then. I assume you're in the camp of they're going to cut this week. What are you going to be paying most attention to at the press conference and in the sort of questions?
So I think we're just going to be looking for, you're right. It's absolutely basically a foregone conclusion the Fed's going to cut this week. But we're going to be looking to Powell to see, is he going to give any guidance for December? Because, for our current outlook, we're expecting the Fed to basically stop their cutting cycle this week, right? And just cut twice this year, take a risk management approach. We've seen some slowing in the labor market, but our consumer card data is holding up very well. The activity data seems strong still that we do have. But the issue that Powell's going to face and that the Fed's really grappling with right now is that absent last week's inflation report, which was relatively benign, they don't really have any data to go on. They don't have official data to rely on. So what will they do kind of heading into that December meeting? So we're all going to be looking to see, is he going to commit to December? It's really doubtful given that he doesn't have much data on hand. So I would expect we're really not going to get much out of this meeting in the end of the day.
So if that's the case, how and given that absence of data, how are you, Stephen, trying to figure out where the economy stands?
Well, fortunately, at B of A, we have a great set of internal data that we've done for some time. We publish on our consumer data. So we have a good read on that, a good pulse on the consumer. And that's been holding up well throughout this year, despite kind of that job market slowdown. There's also the private sector data on the labor market, ADP, Revelio, UKG, Paychecks. The list kind of goes on and on there, where you can cobble together something about how the labor market's doing. But the real issue is that we don't really have great inflation data. And that's really something that we would expect to see a relative acceleration in the fourth quarter, not significant, but still firm inflation print. So we can get a picture of consumption and labor out of alternative data. It's no substitute for the official data, but we can at least have a picture there. But inflation is really that missing ingredient. So I think the Fed's going to be doing the same thing. And then, it becomes harder to kind of walk through that dark room or, continue to follow your path in the absence of data right now. So December will be an interesting meeting for sure, especially if they don't have data on hand.
Yeah. See, the other thing I want to ask you about when it comes to data is we have a lot of not macroeconomic, but more microeconomic data in the form of earnings, right? We're in earnings season. We're getting a lot of these companies that are commenting on things like price increases, things like the state of their workforce. We anecdotally have seen a number of layoffs recently from the likes of Target and other companies. Are you able to extrapolate something from those kinds of reports?
Definitely. And I think what's interesting is our equity strategists have been flagging that optimism's improving. And this is something that I think is critical to our own view, that we're going to see this resiliency of the economy actually lead to a bit of a broadening out of job growth over the coming months, a bit of a broadening out of the CapEx outlook. Right now, the economy has been driven relatively narrowly. We're talking about jobs being created just in the healthcare sector, investment really just an AI story. But if we get that breadth starting to emerge, I think the Fed will feel a lot better about the economy then. It won't feel as fragile, and they won't have to cut all the way to, say, neutral. They can kind of just take this risk management approach and then go on hold again for a while and see how things play out. So that's what we're taking from the earnings report. Obviously, there's been a lot of beats, so that's positive too. We've seen a positive wealth effect probably contribute to a strong consumer. And obviously markets continue to rally, so that's a positive for the consumption outlook too.
Yeah, and for that wealth effect. Stephen, finally, I want to ask you a question about U.S. and China, because we got those headlines that it looks like the U.S. and China are moving towards at least a détente, maybe some sort of framework for an agreement. We haven't talked about it as much lately from an economic perspective because it's been this sort of back and forth. But I am curious in terms of U.S.-China trade and its contribution to U.S. economic growth, kind of where we are now versus where were on the last day of 2024. You know, like how do you even sort of compare that, and what does that look like?
So, I mean, both countries, I think, have done a decent job of decoupling from one another in terms of economic impacts. The U.S. is a large closed economy, so depending on, say, exports to China, soybeans, airplanes, that's not really going to make or break the U.S. economic outlook. And the same kind of goes for China at this point, where exports to the U.S. really isn't going to make or break their economy. So I don't think that's something that we have to be too concerned about. But I think we need to see this détente that you mentioned, because obviously some of these materials we need for autos, for defense, right? We could see supply chain disruptions if we don't get rare earths. And likewise, what we saw in the event earlier this year when the U.S. hiked tariffs to 145% on China, well, that's just not sustainable. So we can't really go up that high. So there is a point where trade really is integrated enough, and you can't decouple all the way, but they have decoupled over the years. And this really started during Trump's first administration. So obviously we got good news about the framework over the weekend. It seems like there's going to be de-escalation. That should be a positive for both economies, all else equal.
Well, fresh data from FactSet shows corporate profits are holding steady. The chart here that we're going to show you shows net profit margins for S&P 500 companies are coming in above their 5-year average for the 6th consecutive quarter, and analysts expect the trend to continue into next year. Joining us now, Michael Reinking, NYSE senior market strategist. Now, Michael, thank you for being here. There's a lot of macro headline stuff going on. So I wanted to start with and bring it back to earnings, and then maybe we'll get to the headline stuff.
Sounds good.
And that is profit margins are okay, which is perhaps surprising given all the noise.
Yes, yeah, and look, I mean, overall, right, the earnings season thus far has been very solid, right? We've seen, the financials kind of came out of the gate, pretty strong numbers, particularly at the money center banks, kind of helped by trading and kind of the investment banking, right? And now we're starting to see kind of the earnings start to broaden out. Last week we started to hear from some of the industrials, and with a lot of those companies, pointing to that solid AI, infrastructure demand, kind of really driving those numbers, right? The regional banks weren't quite as strong. We had that brief, very, very brief kind of credit scare, there a couple weeks ago, and then this week we really kind of get into the meat of, kind of the tech earnings, kind of in kind of the middle of this week, and that's going to really be kind of probably the biggest driver of the market this week.
And do you think it's going to be a positive driver?
Right. So I mean, that's really like the question I think about all of these catalysts that we have this week. That we have high expectations, right? We've now reshifted the expectations for kind of China, right? We have high expectations for the Federal Reserve to cut rates. There's also very high expectations for those tech earnings, right? And so what we've seen is a lot of kind of deal announcements, and it's hard to keep kind of feeding the AI hype, right? And we're going to see solid numbers. It's just a question of kind of how markets respond to that on the back end. I can't imagine that we're going to hear anybody really suggest that we're slowing down in some of that CapEx spending this quarter, right? It's just, we're just hearing everybody kind of ramp that up, right? So I don't think we're going to hear that sort of inflection point from here. Now, what we've seen kind of within the market, right, is we've seen, very interesting reactions. So if you look back last week to GE Vernova or Vertiv, right, they had very, very solid earnings. Stocks gapped up, kind of sold off pretty sharply during the session. But if you look over a 2 or 3 day window, they kind of ended up right back where they were, right? So there was a lot of volatility. I do think, options positioning is driving a lot of that, kind of at a single stock level and, kind of at the index level, right? And but we'll have to see kind of how markets, take this week's news.
Yeah, we will. And in the meantime, before we get to all of those earnings, we have headlines out of Asia, right? That Treasury Secretary Bessent is confident that they have a framework of a potential deal. It still sounds pretty provisional, but that's enough for markets.
Right. Yeah. And I think from a market perspective, right? So now you've shifted the expectations a little bit higher. We'll see if we get kind of the removal of the fentanyl tariffs or what we actually get. soybeans, soybean purchases and things of that nature. But I think the removal of that overhang, right, or pushing out that overhang, right, allows markets to continue to operate, kind of as, on the kind of the status quo, which is at this point, kind of continuing to move higher, right? So we saw, as there was that little bit of a scare on 10-10, right, we saw that massive reversal, kind of within the market. You had that 3% drawdown, the biggest drawdown we'd seen since the last time we talked about kind of trade wars, right, back in April, right? But we've now kind of worked that off, that reset some of the positioning, kind of within the market, as you had a scramble for for protection, right? And then that's very quickly unwound, and now we're kind of pushing to fresh highs. And
so basically, it allows people to just focus on the earnings and the other stuff rather than having to worry about the trade headlines.
And those numbers, right, as we just talked about, have been kind of very solid, and you're looking at kind of the expectation that you have, kind of strong earnings growth as we head into next year, double-digit earnings growth again. Hopefully we start to see kind of some of the investment that is being put kind of into the U.S. economy start to flow through to corporate earnings, to kind of the economic data.
The Federal Reserve is the other thing that's having this week, an interest rate cut expected. How, when you talk to people on the street, how are you all operating without the government data right now, except for CPI?
Right.
It seems like that's the last we're going to get for a while.
Yeah, and there's a lot of different private data that's out there, right? In terms of kind of what the central bank is kind of using, and what the street is kind of using to kind of see kind of where the economy is moving. And then if you listen to kind of the conference calls, right, and corporate commentary, right, they're continuing to tell you that the environment is very much the same as it has been, right, where there's some caution on the hiring front, but we're not seeing kind of mass layoffs, right, in terms of kind of the labor market. And they continue to tell you that the consumer, we have a kind of a K-shaped kind of recovery, but the consumer, particularly at the higher end, is holding up well. The lower end consumer, the lower income consumer, right, is struggling with kind of the cumulative impacts of inflation. But in general, right, we're seeing kind of the economy hold up pretty well.
So what does that mean then? Is the Fed really a catalyst for markets this week? How are you kind of treating it?
Right, so I think the 25 basis points is pretty much baked in. There's some possibility that we do hear kind of the end of QT, right? I think the expectations for that have started to ramp up. You've seen multiple kind of major investment banks kind of call for that to happen at this meeting, if not the next. Fed Chair Powell tends to like to, as Jennifer kind of mentioned, kind of maintain their optionality, right? So I don't think he's going to necessarily fully bless a kind of December rate cut. But I think markets are telling you that that's coming, right? And as you kind of got the CPI data last week, where we didn't get that big upside surprise, right? We started to see shelter finally start to kind of be that kind of the offsetting force to some of the inflationary categories. That allows the Federal Reserve to continue to move forward, and you're now seeing markets start to price in a third cut, just slightly better than a coin flip in January, right? So you're seeing kind of expectations continue to just move a little bit higher.
Interesting. We'll see what happens after this week. Thanks so much, Michael.
Thanks for having me.